Good day, fellow investors. I want to go through Goldman's 2025 outlook because there are some very good insights there. Apart from a Wall Street investment banker being bullish, so their forecast is for higher US GDP growth than consensus, they are expecting inflation to go down, which will also allow the Fed to lower interest rates. In case of baseline targeted tariffs, well, then inflation could go up a while, but then decline as projected. If there are higher tariffs, a risk scenario, their inflation could go up again, but then again come down. And if we look at the US GDP growth forecasts, those did beat expectations 2023, 2024, and Goldman is expecting also same to happen in 2025 with a risk case a little bit lower due to tariffs for a while. US recession fears decline, so less than 15% chance for a recession. The outlook is for the Federal Reserve to continue to cut the funds rate down to a terminal neutral rate of 3.25 to 3.5, which is much lower than what we are seeing now. Globally, GDP forecasts stable, all good, above trend for the US, even some growth in the euro area, so countries there, China reaching the 5% almost, then still slowing a little bit down, but still very, very high. And there could be the impact of the tariff effect on US growth that can slow it down a little bit, but that's something that has to be seen. A little bit stronger impact on the euro area and also on China, but China has already released stimulus to prevent any negatives from the tariffs increases. On the markets, the forecast is for earnings per share of the S&P 500 to just continue growing. Let me now give you my opinion here on Goldman's. I have been investing for 22 years. I have seen many of these predictions, and I might agree in line with Goldman. First, let's start with the earnings predictions, and if I look from 2007 to 2023, earnings per share of the S&P 500 grew 6%. But now their estimations are for 10% growth, and even higher if you look at the real earnings, accounting for all real earnings, we are at 200, 190. So earnings will grow almost 50% in the next few years, according to Goldman. That might be a little bit exuberant, but Goldman is not stupid. They're investment bankers. They know exactly why they are saying what. They are exuberant. They are projecting all good things. And that is what has happened in the past, and they are just projecting it forward. That is needed for all those clients. They have to just keep on investing. But keep in mind, they are smart, not stupid. And the smart part comes here. So they give you the projections, the beautiful charts, and then they simply tell you the S&P 500 PE multiple has increased by 25% during the past 2 years. Today the PE multiple equals 21.7, the forward one, and is at the 93rd historical percentile. So 93rd historical percentile, only 7 years of the last 100, the S&P 500 has been more expensive than now. And at the end of 2025, the index traded at a forward multiple of 17. So they tell you that there are also risks. The market is pricing in optimistic economies, everything looks great, but high multiples are weak signals for near-term results, but typically increase the magnitude of market downturns when there are negative shocks. So if there is a negative shock, expect an increase of market downturn after and from these levels. And they tell you everything right there very, very well. And most importantly, they tell you, as a result, we believe investors should take advantage of periods of low volatility to capture equity upside or hedge downside through options. So they make these presentations and then they just tell you at the bottom, hedging through options, capturing equity upside, extreme risk of the market, but that's not the story the public wants to hear. But they tell you in the lines there if you go and read. As I told you, Goldman is not stupid. They are warning us about the risks. Now, my take on predictions is that I simply do not care what happens. If I am worried about what could happen, a recession, market crashing, this or that, then I'm already in trouble. I have to invest in a way that whatever happens, I am okay. I can be hedged, I can have good dividend cash flow businesses that are recession proof, where I can then reinvest the dividends. I can have some cash as Buffett, but I have to be structured in a way that whatever happens, I'm okay. We can have everything good, but also interest rates could rise, inflation can come back, the economy can slow down, things can go not as planned. That's also a given. For example, this is Ford share 58% down, or Stellantis. Things simply didn't go as planned. So what matters is that nobody knows what will next year look like, but exactly that means that you have to be ready for anything, and exactly that means that you need to understand the risks and you need to understand the rewards. And that's something we do on his channel by focusing on a value investing mindset. If you want to learn more about that, subscribe and check my other videos.